Welcome to the weekly market recap with SC Securities. Let's take a look at some of the latest developments in the Sri Lankan economy and financial markets. Sri Lanka's Board of Investment says the country is on track to cross the $1 billion mark in foreign direct investment this year. According to BOI Chairman Arjuna Herath, inflows reached $607 million in the first 7 months of 2025. That's more than double the amount recorded in the same period last year and almost equal to the full year total for 2024. Officials say the outlook is supported by a strong pipeline of projects. By the end of July, the BOI had approved 63 investments valued at $776 million. Of this, 34 were brand new ventures while 29 were expansions of existing businesses. Together, these projects include $500 million in FDI and $276 million in local investment. The investments have already created close to 1,000 new jobs. Meanwhile, exports from BOI-managed companies reached $4.56 billion between January and July. The Treasury Secretary, Dr. Surya Perumal, said the surge reflects more than tax breaks. He pointed to political stability, consistent policies and improved digital engagement as part of the country's strategy to attract investors. Looking ahead, the BOI plans to expand its infrastructure to support growth. 2 new industrial zones are expected to be launched this year, with a total of 7 zones scheduled for completion by early 2026. Officials say these projects will help spread investment and job opportunities beyond Colombo. Sri Lanka's apparel exports recorded solid growth in July, climbing almost 10% compared with the same month last year. According to the Joint Apparel Association Forum, export earnings reached $455 million, up from $414 million a year earlier. The strongest performance came from the European Union, excluding the United Kingdom, where shipments surged nearly 27%. Exports to other markets rose 24%, while the UK posted only a slight gain. However, exports to the United States fell by almost 3%. For the first 7 months of 2025, total apparel exports stood at $2.9 billion. That's a 9% increase over the same period in 2024. Growth was broad-based, led again by the EU market with an 18% rise. While exports to other destinations grew 11%, the UK 6% and the United States almost 3%. Industry representatives said the results demonstrate the adaptability of Sri Lanka's apparel sector and its strong standing in key global markets. They noted that manufacturers are working to meet buyer expectations on speed, quality and compliance. Sustaining this momentum, they added, will depend on new trade opportunities, supportive government policies and greater value addition across the supply chain. Residential land prices in Colombo have risen sharply in the first half of 2025. According to the central bank's land valuation index, prices jumped by more than 14% compared to a year earlier. Commercial land values increased by 11.5%, while industrial land rose 8% during the same period. Overall, the land value index recorded a gain of 11% year-on-year. On a half-year basis, prices climbed over 8%, pointing to strong momentum in early 2025. Economists say the rise reflects a broader recovery in Sri Lanka's economy, helped by tighter monetary policy and improved stability. However, they also caution that lower interest rates may be fueling asset price increases. Analysts note that in past cycles, suppressed rates and currency instability pushed investors towards land as a safe store of value. But they warn this dynamic often leaves wage earners and savers at a disadvantage, making it harder for ordinary families to acquire land or build homes. The central bank's index also highlights that despite the steep currency collapse in 2022, land values have held steady and continue to rise during the stabilization period. Sri Lanka's non-banking financial institutions are expected to record strong loan growth over the next year. Industry projections indicate that sector lending could expand by 18% year-on-year by June 2026. The outlook is driven by two key developments: the reopening of motor vehicle imports earlier this year and the central bank's relaxation of loan-to-value limits on vehicle financing. Analysts say these changes are widening the borrower base and boosting demand, especially for lower-priced private vehicles. On the supply side, the sector is starting this cycle from a position of strength. Liquidity buffers stand well above statutory requirements, while capital adequacy ratio remains close to 24%. This provides room for balance sheet expansion, though experts caution that recapitalization may be needed as lending grows. Demand conditions also look favorable. Rising household liquidity and growing middle-class spending are expected to lift consumption and leasing volumes. With benchmark interest rates anchored at 7.75% after a series of policy cuts since 2023, further supported for credit growth is anticipated, possibly with another rate reduction in the coming year. With benchmark interest rates anchored at 7.75% after a series of policy cuts since 2023, further support for credit growth is anticipated, possibly with another rate reduction in the coming year. Industry analysts believe these factors together set the stage for a volume-led recovery. They expect loan growth to remain in double digits, margins to narrow slightly, but overall profitability to improve with better returns on equity. The sector is also seen attracting investor interest as confidence in its recovery strengthens. Let's take a look at this week's Treasury Bill auction results. With the recent Treasury Bill auction, the 91-day T-bill rate stands at 7.58%, down by 1 basis point. The 182-day T-bill rate stands at 7.89%, and the 1-year T-bill rate stands at 8.03%, showing no change compared to the previous week. Thank you for watching. We'll be back next week.